So let me talk a little bit about the housing situation in Vancouver. We wrote a newsletter as a company about, I think this is about a year ago, and talking about what the problems were, especially in the Vancouver marketplace. Based on median income, the second most unaffordable major city in the world. That's us. So shortly after this came out, there was another article. Now, I don't know if you... Maclean's magazine tends to be very dramatic in how they present things. So basically, they talked about the real estate market in Canada overall. It was going to crash in 2013. They were 100% certain that this was going to take place. Now, they have only got 26 days left for this event to actually unfold. But at some point it might, but I guess it still begs the question, is there a bubble? So let's examine this. You're looking now here at a graph that it shows the housing prices, the condo prices, and the townhouse prices in Greater Vancouver since 1977. And if you take a look at it, there's been ups and downs, and there's no question that our real estate market is quite capable of correcting 15 or 20%. It's done it before. It will occur again in the future at some point. But on average, prices have gone up around 7.5% a year over that time frame. But in the last 10 years or so, they've gone up at 10% a year, or about 3% above that long-term rate. So what would it take for us to go to mean revert to the outcome, that 7.4% rate? Well, we could either have 4 years of flat prices. Now, this last 12 months, we'll look at in a second, has been more or less a year of flat prices. Or prices would have to drop by 20% in a single year, and then we'd be back to trend. And the fact is that that has happened. If you take a look here in this period of time, this is in the late 90s, and also obviously after the big interest rate rise in the 80s, the markets did correct roughly 15%. And when they corrected, they took 6 years to get back from peak to peak. So it's a very slow grind. It took on average 3 years to go from peak to trough, and another 3 years to get back to where you were before. These are the housing price changes. This is from the MLS database. Single-family homes this is in the Greater Victoria and the Greater Vancouver area in the last 12 months. Basically, no price increase, and far less than other cities in Canada. And the same has been true over the last 5 years. We just have a bigger base that we're working from. But the reality is, as this graph shows, that we are still incredibly expensive, price to rent ratio, compared to where we were before. We're the third most expensive. And now we're talking about Canada as a country as opposed to just Vancouver by itself. There is a website. Unfortunately, it's not there anymore. I don't know because maybe their predictions weren't perfect, but 2 years ago, you could go to this website. And this website, it would explain, there was a clock on it right there. And this clock said 2 years ago that in 1,509 days, 10 hours, 42 minutes, and 22 seconds, that would be when this housing market would collapse, and not a second earlier than that. And so that way you didn't have to worry. You could buy a house, as long as you could sell it appropriately, it would all be good. So just so you know, you have 2 years left before Houseageddon officially arrives. There were 2 articles recently in the Globe and Mail about the condo bubble in Toronto. Their concern, interestingly, wasn't focused on the sheer number of condos being built in Toronto, which is a massive amount of condos. It's the fact that for the first time in a lot of years, average rents in Toronto dropped simply because of the volume of condos that are available in the marketplace. They didn't drop by much, a little less than 1% from the year before, but the fact is they did drop. And that's a real interesting problem because virtually it's impossible without a 30 to 40% down payment to buy a condo either in Vancouver or in Toronto and actually make it break even. So it's one of the reasons why we have no interest in this marketplace. The average capitalization rate of a condo in Toronto or Vancouver would be maybe 2%. And that's assuming you paid 100% cash after expenses. Now there's another side to this argument. One of the most livable cities in the world, so Toronto and Calgary, much the same. Lots of articles from major banks and other organizations about the fact that we're not in a bubble. And then there's another major factor that makes a difference for Toronto and Vancouver, and that's the Chinese diaspora. About a year ago, there was this article talking about the number of Chinese millionaires. So back then, when the article was written, roughly speaking, There were 1 million families in mainland China that had more than $1 million of investable assets. And of that group, 46% said that they intended to leave or emigrate from China for a variety of reasons. It could be safety of capital, it could be education for their kids, it could be simply the climate, the environment, any number of reasons. And when said, where are they going? 37% said that they want to come to Canada. So we're talking hundreds of thousands of people here. And the interesting thing is that most of these people had not yet done the research between Canada and the US as to which of these two countries you might choose. If they choose to go to the US, they will have to declare all of their worldwide wealth and all of their worldwide income. They will have to pay tax on an ongoing basis, even if they don't live in the US, as long as they're considered either a citizen or a resident of the US. And they'll be subject to estate tax on their worldwide wealth, not just the wealth in the US. We don't have an estate tax, and we don't tax people, even if they're citizens of this country, who are not resident in this country. There's a big difference between the two tax environments. Another issue that's come up recently, and you've read the articles that Jim Flaherty's talked about the fact that Canadians are in massive record levels of debt. And technically that's true. So I went to Stats Canada to take a look at all of the information regarding debt and net worth and cash flow and homeowner equity, and this is what we came up with. So the debt at the bottom here has gone from 91% of income in 1990 to 164%. So there's no question it's gone up by a huge amount, and it's very high, at record levels basically. But then when we look at debt to assets, that number has changed somewhat, but not nearly as much in percentage terms. If we take a look at a more meaningful number, what is the average net worth of a Canadian family in relation to their income? It used to be 400% of their income, it's now 613%. So even though their debt, this is after this debt is taken into account. So even after this is taken into account, the average Canadian net worth has increased by 200% from where it was here in the last 21 years. And when it comes to homeowner equity, because the assumption is that people are borrowing huge amounts of money to get into housing, and maybe that is true in the younger marketplace, but when you look at the entire housing market in Canada, this is the homeowner equity percentage. It's virtually unchanged. And we take a look at the US side. The US is up here. And this is the equity, average equity in a US household in their home. It's about 40%. We're up here, we basically haven't changed. So let's imagine house prices drop by 20%. Our homeowner equity would still be 60% of the value of the home, even if that occurred. So I'm not saying that there is only one, that we should ignore this argument here, that people are borrowing too much money, but everything needs context. And this is an argument that needs some context. A lot of people in this room, for example, are incorporated because you're professionals or you're self-employed business owners. The only income that shows up in these calculations is this. Because I called Stats Canada to get this information. If you don't take the money out of your company, none of that money counts as your income. If you income split with a spouse, it doesn't count as your income. If you borrowed money on your home to put into your business or into an investment, it shows up on this debt column even though it's being used to acquire an income-producing asset. And Stats Canada acknowledges they have no way of measuring these other things, so therefore they just have to report what they can report. So when we look at the balance of issues on housing, there are reasons to be concerned. As we said, the 10-year price increase is well above the long-term average. Higher interest rates are coming. We have modest economic growth. Boomers are downsizing, but that's going to mean a surplus of homes eventually on the marketplace. And the price to rent level is the highest in the world. I think that we look at 5-year price increases in Vancouver have been relatively modest, and the interest rate issue is something that may take a lot longer than we think to see significant increases in rates. It's a very livable area. We have the Asian diaspora. We have tax benefits over the US. So I would say if we're lucky, housing prices are going to be flat for a few years, and if we're not lucky, then we should be prepared for upwards of a 20% to 10 to 20% drop in housing prices in the Lower Mainland.